Hi everybody, James here again, or Woody I should say, with another Fat Tail Daily video podcast for YouTube. Today I'm joined by my old pal Callum Newman to explore some dynamics playing out in the gold sector. Hi Cal, you well?
I'm very well, buddy, and thrilled to be back for 2025.
Yeah, it feels like you've been away for a long time, but it's probably no more than normal.
No, just a couple of weeks.
Yep,
Just the usual Christmas break and ready to go again as
good
ever.
stuff. Now, and you've really hit the ground running. Like in today's Fat Tail Daily, you contrast the struggling retail sector stocks and potentially the potential opportunity in gold stocks, particularly given the given the record of the Australian gold dollar price. Now, you kick things off by comparing Maya's situation with gold miners, highlighting the importance of sector tailwinds versus sector headwinds. Could you expand on that and then maybe how investors should think about these macro factors when selecting stocks?
Well, it's just funny. I just thought there was a curious symmetry because, pretty much this time last year, I actually bought some Myer shares for myself because they were so cheap and it just seemed like not a bad idea. And they had a good old rally when they brought out their results early on in 2024 and quite a big rally on one particular day. And that, as I say in the article, was because even though those results weren't particularly that good back then, the market had priced in such a disaster for the retail sector with the idea that there was a recession and the consumer spending that the stock actually went up quite strongly on the day, and the market realized that things were not quite as good, quite as bad, sorry, as it had previously priced in.
Mm-hmm.
That was then. I since got out of Myer. Personally, the reverse has come about where since late last year, Maya had quite a strong rally, and I watched it thinking, geez, I probably sold out too soon there by the looks of things. But I didn't quite get why it was going so strongly either. But interestingly enough, they came out with their latest results. And again, it's not that they're a disaster. They're pretty much flat. But because the market had run up the stock previously, it really got hammered on the day.
Yeah.
And the reason I bring that to your attention, if you're watching this, is that's the kind of thing you have to be really careful of, especially when companies go into February and they start to release their half-year results, that if they disappoint the market, you can really, really get slammed. So the retail sector obviously is a little bit problematic for some of the retailers, not all of them, but it's just a little bit more risky because the tailwinds aren't there, as we alluded to. People are still under the pump with high rates. We didn't get cuts last year, as the market thought early on in 2024. Then you compare that to gold. Well, the gold sector, just as a general thematic, is just booming right now. The Aussie dollar, gold in US dollars is up and about. And of course, the Aussie dollar is falling to a 5-year low. So that just makes the gold price in Aussie dollars a barnstorming 4,000 plus an ounce. So there's just huge amounts of money being made in the gold sector. So just as a backdrop, I really like the gold sector because it's just so strong at the moment.
Yeah, you mentioned the strength, and you also mentioned that while established gold producers aren't the bargains they were a few years ago, explorers and developers still haven't yet seen a frenzy.
Absolutely.
What typically triggers this next phase in a gold bull market then, and what signs should investors watch for? Because assuming like you're still pretty bullish then if you're not seeing the frenzy side of it yet.
Absolutely. I think there's a long way to go in this bull market. Well, I mean, the strongest indication you have if you're watching this is the gold price. That is the most important variable. So it's pumping huge amounts of cash through the industry. Then when you go to the mining sector or any sector really, you want to find catalysts that can move the stocks up. So when an industry is making a lot of money, of course, we're going to see mergers and acquisitions. We're going to see deals, takeovers, which we're already seeing. Gold companies can get financing. If they can get financing because it's got a bright outlook and big cash flows, projected cash flows, they can then go exploring. If they're exploring, then they can release drill results. So it just sets up this whole chain reaction of potentially positive news.
Mm-hmm.
Now, the big gold producers, this is not news, of course, to the market. The market knows that the gold price is high and those stocks are making lots of money, but it's a very stable base for them. And of course, if gold goes higher, the cash flows will go higher. But as yet, the junior sectors, the developers and the explorers, because they don't have the cash flows, they're pre-revenue, they can't just tee off the gold price alone in terms of cash flow. They need that gold price to go high and stay high. So
Mhm.
it's not going to all happen tomorrow. These deals and mergers and things, they take time. It takes analysis. It takes reports. If they're going into mine plans, it takes a lot. There's huge teams involved and all that type of thing. So point being, it doesn't all just happen in 6 weeks. So over the next 24 months, we could see some really interesting deals, moves, and if gold stays high, it's just going to push more and more investors into the sector.
Mm. You also shared an interesting metaphor of gold stocks as burning matches. Can you please explain that for anyone yet to read your piece?
Well, it was just I actually read a book by a mining analyst over the holidays, and he threw out that phrase. I'd never heard it before, but the point being is gold and resources in general, like a lot of sectors, is a cyclical one. And he's like, you want to own them when they're shining brightly like a match, because at some point they'll come and singe your fingers. In the sense that there's always a bear market when a cyclical sector like resources down the road. So if you
Mm.
want to make money out of it, you got to do it when things are good, and you look to go, well, I can ride this for maybe a year, 2 years, 3 years, but you're not going to hold it forever, usually, because there'll come a time when the appeal of gold falls away, or the margins aren't as good, or what have you. So if we're thinking of that metaphor, the match is burning brightly now, so get involved in it.
Hmm. And I guess you can apply that concept practically when managing positions, right? Because particularly regarding position sizing and exit strategies, I mean, you don't want to buy, I'm assuming, when it's burning, when the match is burning, and not have a plan for getting out when it's starting to fizzle.
Absolutely. And of course, with gold, again, from the mining analyst book and my experience, it's always best with resources to buy a basket of something, because there's always wild cards that can go wrong with any individual miner. They're quite complicated operations with the metallurgy and the geology and all this type of stuff. So it's best done with a basket of names, and you can go through. You can do the producers, the developers, the explorers, whatever your risk profile is or what you're interested in. And of course, we've got Brian here who does those different sectors, that coverage. But you need to ideally have more than one in your portfolio.
Yeah. Finally, Cal, you touch on how a high gold price creates a sort of virtuous cycle of cash flows, financing, and deals. How do you see this playing out differently for producers versus explorers in the current environment? And where do you see in 2025 the best risk reward opportunities within the gold sector?
Well, personally, the best place in resources is for upside is always to look at those developers that are close to production but not quite there. Once they get within about a year, they go from the final investment decisions, if they have a particular project that they're building, and they can get to that first pour of gold. That's usually the sweet spot that you want to be on as an investor. Now, there's certain risks that come with that. So you look, I really like the development sector. The biggest potential upside is always from the explorer, but they come with the biggest risk, because
Mm-hmm.
obviously it's very difficult to know which projects are going to pay off and which aren't. So again, it all depends on your risk profile. But at the moment, I like the developers for your best return in 2025.
There you go. We'll delve into that a bit more next week after a further week in, and we can see what the progress is. Cheers, Callum. If you would like to read his piece today, the full link is in the description below. It's absolutely free to go read it. Head over to the Fat Tail Daily website and check out what Callum's article has to say and why it was the basis of today's discussion. Thanks, Callum. Much appreciated.
Absolutely. Absolute pleasure, Woody, and we'll see you again next week.